The Bank of England is expanding its emergency bond buying program for the second time in 2 days as it warns of, quote, material risk to the country's financial stability. Ali Barrett has the details.
Well, government borrowing costs for the UK rose sharply in Monday trading, and that has partly prompted this latest intervention from the Bank of England. It describes a significant repricing in government bonds this week and warns of the risk of a further downturn in markets to come. It is therefore going to buy a wider selection of bonds than it already had been to try and stem concerns that particularly have been swirling around the exposure of some of the UK's pension funds. But that fresh warning from the Bank of England of a material risk to financial stability is pretty stark and may well rattle some investors further. Now, the bank initially intervened in the bond market after the government's so-called mini-budget of tax cuts, which was concerning for some international investors who felt that it wasn't fully funded. There is mixed news, meanwhile, coming from the UK's labour market. The UK unemployment rate has hit a new multi-decade low of 3.5% in the 3 months to August, according to new data. But the number of people not looking for work because they're suffering from long-term illness, that has hit a record high. Data shows that wages have been rising, up 5.4% in the June to August period, but that is not keeping pace with inflation on an annual basis, currently at nearly 10%. The UK's Chancellor, Kwasi Kwarteng, insists, despite all of this, as I say, somewhat mixed news, that the fundamentals, in his words, of the UK economy remain, he says, resilient.
And a quick check on the markets after the BOE's announcement and those jobs numbers. Well, the pound strengthening some against the greenback, while the FTSE is down about 1%.